Should I buy Alibaba? In this particular video, I'll be doing a stock analysis on Alibaba. I'll be going over the company's overview, the key highlights, the streams of income, the competitors and the competitive advantage, the risk factor, the financials, and last but not least, I'll be giving you a personal insight of what I think and whether I think Alibaba is a buy. But before we get started, make sure you smash the like button because it helps the YouTube algorithm. It helps YouTube know that this is quality content and help my videos reach a broad audience. And also, if you're a big fan of finance and investing and you like shirts like this one, The Investing Guru, make sure you check out my store, Wall Street Stock Apparel, where I make custom finance and investing t-shirts. And by the way, I provided timestamps so you can skip around to your likings. So what is Alibaba? So Alibaba is one of the largest retailers in commerce business. So pretty much they make it easy to do business. So they created an ecosystem or a platform that connects business owners to suppliers, as well as the business owners to customers as well. So they have a very versatile business. A lot of times when people think of Alibaba, they think of the Alibaba wholesale, where you can end up buying stuff in bulk from multiple suppliers. But in addition, I wanted to mention that Alibaba is far more than that. So they're also in the sector of cloud computing, digital marketing, and entertainment, as well as innovator initiatives. Some key highlights from Alibaba: they're the 5th largest AI company. They have one of the largest venture capitalist firms. They have over 1.3 million businesses on their platform. They do business in over 190,000 countries. And they also have 779 annual active customers. So here's are some of the companies that will fall under the Alibaba or Alibaba Group. So some of these businesses are in China, so you might not be that familiar with them, but they still are pretty big. So you have Tmall Supermarket, Ali Health, Taboo, AliExpress, Alibaba, Lazada, DingTalk, and many others. I'll have them up on the screen. Now, let's get into the streams of income. About 85% comes from the core commerce, which is like the retail and wholesales. 7.8 comes from digital marketing and entertainment. 5.2 comes from cloud computing, and 1.3 comes from innovator initiatives. Now let's go over their revenue. For 2018, they produced $250 billion. For 2019, they produced $376 billion. For 2020, $509 billion. And for 2021, $717 billion. As far as, let's go to the earnings, we have for 2008, 64 billion. For 2019, 87 billion. For 2020, we have 149 billion. And for 2021, we have 150 billion. Also note for 2021, their earnings would have been much higher, but they end up having to pay a penalty. Let's go over some of the competitors that Alibaba has to face. So we have Amazon, Walmart, Target, Costco's, DJs.com. So any type of online platform that sells good to the masses, they could definitely be a problem competitors with Alibaba. Also, you have to remember, because they're tapping into the cloud computing business, there's also major players with that one: Facebook, Microsoft, Amazon, and even Apple. So a lot of competitors. One of the competitive advantage they have a premier brand. Competitive advantage they have is what they call the network effect. Since 50% of all commerce businesses operate in Alibaba, they have a very established brand and a lot of people already doing business and on their particular platform. Like I said, you have 1.3 million businesses on their platform. They already established and they have that trust. So that's a competitive advantage they do have. Let's go over some of the risk factors that Alibaba's face. So some of the risk factors that they would end up facing is regulations in China, because a lot of times with China, the government have a lot more impact on Chinese companies. Also, you have to remember, any primarily business that operates in China is technically the property of CCP, Chinese Communist Party. So technically a lot of ways that Alibaba run business and can dictate their actions of what they can do and can't do is heavily based off of this one. So a lot of times they control the business. That's also good to keep in mind. Also, any type of trade tensions between the US and the United States, because they also do a lot of trades and goods outside of the country. So that's one of the things. Also, you had some concerns about Jack Ma. He made some comments and he ended up turning up mission temporarily. So those are some things you want to keep in mind. Also, the fact that there was some type of problems with the SEC and China, and some Chinese companies not cooperating, so there was a potential chance that they could be delisted from the New York Stock Exchange, but that seems to be okay right now. And also you have the concern of their financials. A lot of times they're not held to the same standards as US companies, and they don't have the same auditing. So it's, as far as the reassurance whether they're recording their financials as accurate as possible, may be a concern. And also you have major competitors that are also tapping into the e-commerce business in China, which would be JD.com and PDD. So they are also up and coming companies that are tackling into the commerce business in China. So there is a lot of risk factors that you want to end up looking at. Now let's jump in Simply Wall Street to look at the financials and get my personal insight. Okay, so we're on Simply Wall Street. Let's check out some information. If we go to their share price, we can see the last share price recording of this video is $200.96. If you want, we can look at the 5-year chart. As we can see, nice and steady growth. That's always good to see. Let's check out the validation. So the validation is is relatively to the future cash flows that they're projected to have. As you can see, it is considered undervalued compared to that future cash flow. Once again, these numbers are based off assumptions and previous performance. But if you were a value investor, this is something you would like to see, buying undervalued companies because there's more upside. Now, if we look at future growth, according to 50 analysts, in the next 1 to 3 years, their future earnings, their forecasted annual earnings growth will be 10.7%. which is not bad, but I would like it to be a little higher. You can see this is the blue is revenue, the green is earnings. So we see revenue keeps going up, so is earnings. Let's check out free cash flow. Free cash flow seems nice as well. So that is always good to see. And so for forecast annual earnings growth, we have it's for the industry's 28%, where the company's 10.7%. So that is on the little bit of a lower side. So we'd like to see that a little bit higher. But for the forecast annual revenue growth, Alibaba is 16.8 compared to 16.4. So that's good. Now let's look at the past performance. The past performance in the last 5 years, historical annual earnings growth is 29.8. That's not bad at all. As you can see, let's just check out their financials. So their financials, they're in perfect financial standings. Assets cover short-term and long-term liability. That's always good. As you can see, we have little debt. They have enough cash to cover their debt. That's also good. Nice equity increasing over time. As you can see, because Alibaba is still in the growth stages, they don't pay any dividend, which is what I consider normal. And as far as management, as far as years of management, that's pretty good as well. So if we're looking at the P/E ratio, the company's P/E ratio is 24.5 versus the industry, which is 33.9. So relative to the earnings compared to the industry, it's pretty good. But relative to the market, it's still pretty pricey. But with P/E ratios, you would like to compare it to the industry. So the U.S. online retail, the average P/E ratio is 33.9 and Alibaba's 24.5. So that is really good. It's very attractive earnings compared to its industry. Now, if we look at price to earnings growth, it's on the high side, what they consider poor, but sometimes these metrics, these are just ways you can, just different ways you can assess the business. Price to book. So the price to book is 3.9. The lower, the better. Industry's 5.3. So the company, because their price to book is lower than the industry's, that's always good to see. Now for future return on equity, it is on the lower side. It's 16.3 compared to the industry, 21.7%. But Alibaba is still in its growing stage, so you also have to keep that in mind. But in my opinion, as far as do I think Alibaba is a buy, I personally like Alibaba because I have more so like a value investing play. But just know that Alibaba, it is trading at a discount relative to there is a lot of risk concern. Chinese regulators, trade war, whether their financial bookkeeping is accurate, maintaining the premium brand as well as up and coming competitors. But I feel like if you're on a longer time span, at least a 5-year time span, I think this is a solid pick. The stock price to me seems attractive. I'm also looking at, I feel like the downside would not be as much as the upside potential. So I would consider it a good investment as long as you have a longer time frame. Because I think overall, Alibaba will be in good standings in years to come. And that concludes Style Stock Talk. Let me know in the comments below what you invest in Alibaba. And if you haven't already, make sure you hit the like button. And if you're new, make sure you subscribe to my channel.